think about this. If the housing market drops in price, say 3 or 5 years from now, but that will almost always be the result of less affordability and higher interest rates. The question everybody has to answer for themselves is this question: would you rather have the house cheap or the money cheap?
All right, guys, here we go now. It is time to unlock more doors to deals. We're real estate investors here. We're real estate agents here, and we all have one thing in common. We believe that we can. We can live the life of our purpose. We can create financial freedom. We can build a better life for those that we love, and we can live the life of our dreams. I don't care if you're trying to do your first deal or your 500th this year. You can get to the next level, and we're here to help. Welcome to Doors to Deals. I'm your host and founder, Jim Manning. Today's episode can be found on doorstodeals.com/071. Today we have Jason Hartman on the line. Jason's a really known podcaster, and he's a market analysis expert. He likes to study what's going on in the marketplace and use that information to help him make intelligent investing decisions. And we're going to dive into real estate and how expensive or inexpensive it is, and in comparison to what. One of the things that I really have learned and thought about and taken to heart from after this call and after talking to Jason a little bit more is that the way we view things and the way we value things shouldn't be just limited to the dollar. And typically we hear, okay, a house is worth $300,000. It used to be worth $150,000. And then we think, oh, well, maybe it's an expensive piece of real estate in comparison to what it used to be. But that's only if we're comparing it to a dollar. What about if you compared it to what gold has done or what oil has done or what some other measuring sticks would be? What happens then? Is real estate really expensive compared to what? So we're going to go into that quite a bit. It's a great episode. He's got a really unique perspective, and I'm really excited to share it with you. Quick side note, to unlock our best resources, make sure you visit our website on doorstodeals.com, and we're here to help you. Wholesalers, we can help you revive some dead deals if you live in St. Louis and buy them even for top dollar. If you need some funds, some cash to put together deals, we have access to over 20 million that we lend out right here in St. Louis. And then agents, our missions to help 250 people become financially free. And only 10% of you are actually actively investing in real estate or own real estate property. We're here to change that. We're here to unlock long-term investing strategies for you so that you can get to financial freedom and that you can help your clients get to financial freedom at a much higher level than they are now. So reach out to us. Hopefully we can do a deal together soon. And all right, no more talk from me. Here's the interview. All right, guys, Jim and Caleb here again. Another episode of Doors to Deals. Today we have Jason Hartman on the line. Jason has a really well-known podcast named Creating Wealth for real estate investing. And we had the pleasure of listening to Jason talk for, it was at least 20, 30 minutes just about the real estate market. And this guy is an expert. He is so knowledgeable, guys. And I am so excited to have him on and appreciative of you taking the time to kind of pour into our network and our guests. So thank you, Jason, for coming on, man.
Hey, the pleasure is all mine, and I hope I can share some good ideas today.
Absolutely.
If you drop half the value you did while we were at family reunion, our listeners are going to be so excited.
Awesome. Okay, well, how about if we do 60% of the value I gave at the live speech when you saw me? We'll do even better than half.
I love it.
Yeah. So let's just get right into it, guys. Let's get into the nuts and bolts. So talk to me about like the real estate market and kind of what you're seeing, some trends and what's important to be watching for right now. What do you think, man?
Sure. So, many have said that we are in the everything bubble because it seems that prices of everything have just run up so high. There's so much money sloshing around in the world. On my podcast, The Creating Wealth Show, last week, I think it was, I actually did a story about how the private jet companies are now not accepting new members because they can't fulfill the demand. So when you see a really high item like private aviation, private jets, they won't take new members. When I reported on that on my show, I was glad that I joined one of these earlier this year, and I got in. I got my membership to my private jet company. Who would have thought? You would have thought, oh, I got a bargain, because it's so outrageous, And that's just a symptom of like this extreme amount of money that is just sloshing around the world because of the response to the pandemic. And L was inserted on purpose, just so you know. We've just been printing money like it's going out of style. So here we are. So it has driven up the price of real estate, of stocks, of virtually every asset, right? And we've all witnessed that. But one of the things that people really tend to forget about is when they're measuring the prices of assets, like real estate, for example, they only compare it to one thing: dollars. And that is very misleading, and that is a huge mistake. If I have my way, that's a huge mistake. And so what we should be doing is not comparing it to the amount of dollars something costs, because the dollar is a fluctuating item as well, and its value keeps getting debased because so much of it is being created out of thin air. And keep in mind that everything in the world is valued based largely on two things: scarcity and utility. Scarcity and utility. So dollars have a utility because we all agree that that's the medium of exchange, and they are only valued based on their scarcity. So when they create trillions more of them, then they're not as valuable as they used to be. Right? So that seems kind of obvious to everybody except Jerome Powell, Janet Yellen, and Joe Biden. But whatever, right? It's the world we live in. So what I want to get people to do today is really understand that they should be using multiple measuring sticks to measure the value of anything. Now, we'll talk about real estate, but it could be anything else, right? And they need to compare the price in all these different measuring sticks, and we'll talk about some of those today. Does that make sense to you?
Yeah, it does. And why is that so important to you to compare it to more than just money?
Because every human makes decisions on value based on comparison. The only way we value anything in the world is based on comparing it to something else. So if we look at a cheap old car and a brand new Mercedes, we're going to think, hey, the Mercedes is more valuable because we compared it to something else. If we look at communism versus democracy, we value democracy because we compare it to communism and we think that doesn't work very well, right? Except if you're a college student and you're clueless, right? then, or a Democrat, either one, then you might differ. But we make decisions based on comparison, right? And that's why it's so important to compare the price of real estate to other things. But before we do that, we have to understand that we can't just talk about real estate like it's one big singular thing. In a country as large versus the U.S., there are about 400 metropolitan statistical areas, or MSAs. There are over 3,100 counties, and there are a whole bunch more cities, and a whole bunch more than that, neighborhoods, right? And as you both know, real estate is a very localized phenomenon. But I think we can break all real estate markets down into three basic types of markets, and they are linear markets. And these are the slow and steady markets that we recommend investing in. Yours is one of those. St. Louis, where you guys are, is a linear market. and a cyclical market, which are the markets that get all the attention, like where I grew up, Los Angeles. That's a cyclical market. Pretty much the west coast of the U.S. would be cyclical. The expensive northeastern markets, Boston, Washington, D.C., New York, etc., those would be cyclical. And where I live now, or south of where I live now, Miami would be a very cyclical market as well. These markets are like a roller coaster. If you're looking at a chart, the prices go up, they go down, and they fluctuate a lot. And then there is the one that's in between the two, which is the hybrid market. So let's just look at some charts here. Okay, so here is a chart of Memphis, Tennessee appreciation rates since about 1970. And you can see that there are some ups and downs, but they're relatively mild. If you just chart them, they just kind of overall have a slow and steady upswing. Okay. And Memphis is a market where I've owned several properties, where we've helped our clients buy a lot of properties because it's a very good rental market. Houses are inexpensive. It's very linear and very reliable, and they have good cash flow. Miami, on the other hand, near where I live, is very cyclical. You can see it's got lows and highs and lows and highs. And so if you chart that, the variance is much more significant. And then Indianapolis, that's another market where we've helped hundreds of clients buy properties over the years. And that's a very linear market, very boring. Just kind of chugs along and does its thing. Now, the market I grew up in, Los Angeles, look at this one. This is the craziest roller coaster ever. Now, if it was a roller coaster, it would be a really scary but enjoyable ride. But it's very cyclical, and this is not the kind of place you want to invest because it's just all over the board. So, does that make sense? Cyclical, linear, the discussion between those two?
It does. And now some of the the line that you have that's an annual appreciation rate of like 4 or 5%, or
well, I'm not doing the annual here, but it varies so much that during the good times everybody's making a bundle of money and they think it's great, but then the market switches on them and they go down the hill on the roller coaster and they're losing their shirts. And overall, because you give back so much, believe it or not, in many of these markets, the appreciation rate over the long term is actually lower than it is in a boring place like Indianapolis or Memphis. So it's really quite amazing because you're not giving back these huge amounts. Also, your cash flow is much better in these linear markets, and that gives you staying power where you're never really forced to sell a property. So that's very important as well. So that's the first thing I want to say. It's like the tortoise and the hare, right? We all know the fable. The tortoise is just kind of consistent, just keeps going, and the hare runs really fast, but then runs out of energy. Right? And so who wins the game? Well, it's the slow and the steady wins the race. And going back to that compared to what question, now that we know there are three major types of markets, we can start to answer the question of whether or not we are in a bubble, whether or not the market is overvalued, or if it's undervalued or fairly valued. And the statistics I'm about to present to you are national. So they include all of these markets. But the problem is all of these national indexes weight heavily toward the cyclical markets and less toward the linear markets. So we have to just understand that going in. And we have a free white paper. If anybody is interested and they get on our mailing list, they all get an offer for the white paper. All they need to do is go to jasonhartman.com and just sign up on any of our web forms for anything on that site, and they'll get the free white paper. And it'll go into more detail of the comparison index compared to cyclical and linear markets, so it drills down further than we have time for today. But we want to answer this question, compared to what? That's really the most important question. And that really means, is it cheap or is it expensive? So we've got the Hartman Comparison Index to answer that question. And I know you saw some of this when you saw me speak live, but do you have any questions or thoughts before we dive in?
No, go right ahead.
Yeah, I'd say no. Keep going. Keep rolling.
Okay, cool. So let's go back like 31 years, for example, and let's go to 1990 and look at the price of the median price house. The median price house then was $121,500. And at that time, gold, now I'm using gold as one comparison, one measuring stick, and I just have to say, I'm not a gold bug. Gold is okay as insurance, but the reason I use it is it has been a measuring stick for most of the human population for thousands of years. Gold has been considered money for a very long time. I don't think it's a very good investment because, it doesn't provide what income property does. You can't use leverage. You don't have tax benefits. You can't rent it out. Income property is a much better investment. But gold is a good measuring stick, so let's use it. Okay, so 1990, the median price house was just about 121,000. Gold was $4.15 an ounce. If you wanted to buy a house in gold rather than dollars, you would have needed 293 ounces of gold to buy a house. Now today, or as of September this year, a median house price was $380,000. And gold was almost $1,800 an ounce, and you would only need 212 ounces of gold to buy the house. So isn't that interesting that in 31 years, most people, because they're only using dollars as their measuring stick, they're only comparing the price of a house to dollars, they would think it got a lot more expensive. But priced in gold, the house actually got cheaper. Surprising?
Yeah, and what's fascinating is with the inflation and with some of the policies that have taken place with COVID. I mean, it feels like this is even more important to do this than ever before.
It is, yeah.
Correct, yeah.
Absolutely, because the dollar is a moving target. We can't compare things to dollars anymore when they keep printing more of them out of thin air. The value keeps declining. So we've got to compare to other things. So priced in gold, real estate is cheap. Okay, let's look at oil. Oil is one of the most important commodities to the human race. I mean, it runs the world. Okay, oil is a super important commodity. So, let's look at the year 2000. Right? So, 21 years ago, median house price was $172.9. Oil was $27 a barrel. If you wanted to buy a house in oil, it would cost you 6,361 barrels of oil. Today, the house is $380,000. Oil at the time of this is $68 a barrel. It's different now for sure, but somewhat close probably. And it would only take 5,600 barrels of oil to buy the house today. So it got cheaper. In fact, if you look over several decades, let's just do that. Going back to 1970, a house cost 6,700 barrels of oil. I'm rounding off here, obviously. Today, it's only 5,600 barrels, so it's cheaper than it was 51 years ago. But 41 years ago in 1980, it's actually about 2.5 times more expensive because back then the house was $66,000. The oil was $33 a barrel. And it would cost you about 2,000 barrels to buy a house versus today, more expensive, 5,600 barrels. But go one more decade and watch what happens. Go to 1990, it's 5,366 barrels. Today, it's 5,590. It's only 200 barrels more. It's no big deal, okay? As I said, in 2000, 6,300 barrels. Today, it's cheaper than it was 21 years ago. It's more expensive than it was 11 years ago, and it's a little cheaper than it was in 2020, the pandemic year. So interesting to just look at that, right?
Yeah, what's fascinating about this is this just shows you the swing that any one commodity, whether it's dollars or oil, right, can do over decades. So So then this is really why when you're doing these comparisons, you're not just taking gold and comparing it to housing. You're not just taking oil and comparing it to housing. You're having multiple different avenues to kind of measure and judge. And so your comparison index is like how many different how many different like commodities are you using, or how many different measuring sticks are you using?
We use the main index uses 24 commodities. Okay. And one of the things that is amazing in what you just said is, we're not just comparing it to one thing, and you're right. But isn't it interesting that before people listen to this interview, they probably just compared one thing, dollars? I mean, do you see how flawed that would be if we just compared it to oil or just gold or just Bitcoin or just anything, right? So we want to compare it with a whole bunch of things. That's what makes a valid, viable index. So priced in oil, overall, housing is actually cheap. It's not incredibly cheap priced in oil, but it's fairly cheap. Okay, let's look at rice. Why rice? Well, rice is the food stock for 2/3 of the human race. I mean, this is the base food for 2/3 of humanity is rice. So rice is sold in what's called hundredweight. And if you look at the median house price and how much rice it would take you to buy that house over the years, 51 years ago, it took 42,000 units, 43,000 units if I'm rounding. Today, it only takes 27,000. So it's cheaper priced in rice. It was the cheapest in 1990, where it only took you 17,000 units, but it's pretty darn cheap. I mean, compared to even 51 years ago, compared to 41 years ago, compared to 21 years ago, it's cheaper. A little more expensive than it was 11 years ago, which nobody will be surprised because most people say 2010 was a super cheap time to buy real estate, right? But it's interesting when you compare it to that, right? So priced in rice, housing is cheap. Okay. What about something people relate to maybe a little more, like the S&P 500 index?
Hey there, if you're looking to get the ultimate edge for your real estate investing company, go to doorstodeals.com/invest for more information. Just so you know, a high percentage of the people that we interview on this podcast are actually already Three Doors Network members. And our network members have a lot of extra resources. They have access to an online training vault with over 3 years worth of content in it. They have access to vendor savings like our Home Depot discount that's literally saved thousands of dollars for members. And we have a weekly group coaching call, and we have a lot of other great things as well as part of the Three Doors Network. So make sure that you check it out on doorstodeals.com/invest.
What about something people relate to maybe a little more, like the S&P 500 index, okay, a stock index? Well, let's take a look at that. So back in 1970, when the median house price was just over $22,000, a share of the S&P was $93. So to buy a house back then, you would need 243 shares of the S&P 500 index. Today, you only need 80 shares. Isn't that amazing? Caleb, you're muted. I see you trying to talk there. Did you want to chime in on that? Okay. So you only need 80 shares today. And if you look historically, in 1980, it was the most expensive when the S&P was $106 and a house was $66,000. But everybody would think, wow, if I bought a house, in 1980, I would have saved so much money. You sure about that? Right? Because it depends what you're buying it in. Now, some people will say, Jason, this is silly. Like, why are you even talking about all this stuff? Because, look, I save my money in dollars. Well, no one's forcing you to do that. Take this example, okay? Say today you do not own a house and you want to buy a house or an investment property. So you get paid every 2 weeks and you pay for your living expenses, and then hopefully you have some money left over and you save that money or invest that money. So the question is, when you have those extra dollars, do you keep them in dollars and just put them in the bank, or do you convert them to another asset like shares of the S&P or gold or rice as a commodity or oil? You can invest in all these things with your dollars. No one forces anybody to keep their savings denominated in dollars. That's why this matters, because you can see if someone has to save for 10 years house, it's going to make a giant difference how they save and how they store that money. It could cut years off the savings curve, right? So it matters in a lot of ways. Make sense?
Yeah, absolutely. So how do we, do we take all these indexes, and I don't know, do you have like a slide for like your actual index that combines it all, or like how do we like as a listener, how do we apply this now to what's going on in the market and what strategy we should use?
Let me give you a couple more comparisons. And yes, there's a lot more in the white paper. I think the white paper is like 17 pages long or something. Okay. It's got a lot of charts and graphs and a lot of data. But let's look at something else. Let's look at services. How about haircuts, right? That's a service that most everybody uses. In 1970, it would take 9,100 haircuts to buy a house based on the price of a haircut then and the price of a house then. Today, it takes 9,600 haircuts. So if someone's listening and they cut hair for a living, this is important to them. Or if they're going to get 9,000 haircuts in their lifetime, right? You understand that it's another comparison, because we're not only comparing commodities, we're comparing services too. Okay. And that's another comparison. And the other thing we've got to realize is we should also compare it to the house payment, not just the house price. And then when you compare it to the payment based on these incredibly low interest rates we have, it gets a lot cheaper. So let me just show you the payment adjusted for inflation. We're still talking only dollars here. This is only dollars. We're not comparing it to anything else. We're just comparing it to the time value of the dollar based on the official inflation rate, which is very much understated. So in 1970, the median mortgage payment was $142. Okay. Today, that mortgage payment is $1,170. But if you adjust those dollars for the official rate of inflation, which is a scam, that's the CPI, it's manipulated, it's understated, it's a lie, but let's just go with it, okay, and use the official rate. The median mortgage payment today is only $169 adjusted for inflation. Compared to 1970, it's hardly any more than it was. And I would argue that the house today is quite a bit better than the house was in 1970.
Yeah, I think there's two really main factors here to think about. Is the house is built in 1970, were 1,000 square foot. I mean, they were throwing houses up everywhere because they could. And then also, like for you realtors, you have so many people right now that are talking about housing is so expensive. Housing is so expensive. Use this data to talk to your clients on an educated level, and how much more value you're bringing to your client when you can know those objections. Yeah,
definitely get the white paper. You can share it with your clients. It's totally free. You can also get it. I have a little mini book that I created adapting a lot of my investing strategies for the pandemic. That's available at pandemicinvesting.com. That's pandemicinvesting.com. And so either place you go, just get on our mailing list. We regularly send out emails with a free copy of the white paper. And you also may want to keep in touch because the white paper will be updated and will change. We update the index every quarter. Okay. And it changes quite a bit. But yeah, Caleb, you're absolutely right. People really just need to understand what they're doing, because if they compare only to the dollar, they're making a huge mistake. Let's look at the mortgage payment just a little more for a moment. Gold. In 1970, if you had some gold and you wanted to pay your mortgage every month, you would sell some of your gold, convert it to dollars, then pay the mortgage, right? Okay. Well, back then it took 4.1 ounces of gold to pay your monthly mortgage payment. Today it takes 0.7 ounces of gold. So priced in gold, your monthly payment is incredibly cheap.
I mean, it's never been cheaper compared to gold to pay your mortgage.
In the past 51 years, it is now the cheapest of all. And that's because the interest rate is so low. Okay. You're literally borrowing at negative interest rates. You're getting paid to borrow the money. Okay. Let's look at barrels of oil. Okay. 42 barrels in 1970, 17 barrels in 1980 to pay your mortgage. So if you owned oil, you would sell some of it, convert it to dollars, pay the mortgage. That's what this equation is. 38 barrels of oil in 1990 to pay your mortgage, 36 in 2000, only 12 in 2010. That was by most standards, the best time to buy was 2010-ish, give or take. But today, only 16 barrels. So it's not the cheapest, but it's the second cheapest in 51 years. Isn't that amazing? And of course, these are decade by decade, all these numbers. So there could have been a time within the decade where it changed. We can't go over every day's pricing of all these things, obviously. But yeah, it's really interesting. Last one. How about average hours worked? Let's do that one. Okay. How many hours of labor does it take to pay your mortgage? Well, based on the average wage and the median mortgage payment in 1970, it took 41 hours to pay your mortgage every month. By 1980, it went up. It took 78 hours. Then 83, it peaked out in 1990, started coming down from there. In 2000, it was 69 hours, but still more expensive than it was in 1970. Today, it's 46 hours. So it's 5 more hours you have to work to pay your mortgage today. Fair statement. Wages have largely not kept up with inflation. So hopefully you're not dependent on wages and you're making your own paycheck because you're self-employed or you've got a side hustle or you're investing, right? And most people listening probably do those things. So
we're spending so much time now compared to 1970. I don't think 5 hours was saved by technology. You're not even realizing that would be gone.
Yeah. I mean, but for the typical worker that's just on a salary, this is what it looks like. Okay. So it's not the worst it's ever been, but it's not bad. Okay. It's been much worse than this. In 1990, it was almost twice as bad. So yeah, what do you think?
This is amazing content. I'm so thankful you got to share this with us and our team and everyone who's going to listen to this podcast, because to me, having this knowledge in your back pocket, we talk about value on the podcast so much, and this brings your value up. You can sit down and people are saying, I mean, it's all over social media. Our parents, it was so much cheaper for them to buy a house. Right. Everything else.
Yeah, it's not nearly as expensive as you think. And in the white paper that you can get at pandemicinvesting.com or jasonhartman.com, either one, doesn't matter, it compares the linear markets and the cyclical markets. Okay, so it's not just doing the national stuff like we did today, but when you compare this to those linear markets, all these numbers discussed look even better, and it looks cheaper. So housing is a pretty good deal still. So if everybody listening is like looking for some huge crash, it's not right around the corner. Okay.
That's the same message that I keep saying to people. It's like, everyone's like, oh, a bubble's coming. Like, yeah, you and 10,000 other people think a real estate bubble's coming, and you're all telling me you're waiting to buy a house for the bubble.
Yeah.
I'm going to keep buying real estate, and it's going to keep going up.
Yeah, people like that are going to be sadly mistaken. Look, there will be a correction at some point. I mean, I'm not saying there won't be. Of course, there are always corrections. But, the other decision people have to make is this one. Here's the question. When you get a 3-decade-long fixed-rate mortgage at literally negative interest rates, where the official inflation rate is 6.2% now, and you can borrow a mortgage at about 3%, give or take, right? So that's pretty awesome. You're getting paid 3.2% to borrow the money, even if you don't rent the house out, right? You're getting paid to live in it. But think about this. If the housing market drops in price, say 3 or 5 years from now, but that will almost always be the result of less affordability and higher interest rates. The question everybody has to answer for themselves is this question. Would you rather have the house cheap or the money cheap? Is the mortgage going to be cheap or is the house going to be cheap? You're unlikely to get both of those at the same time. In 2010, the mortgage was much more expensive and much harder to get, but the house was cheaper in dollars, at least, right? So these are the kind of things people need to think about. And I hope I've brought some of this new thinking to people's attention.
Yeah, a lot of times,
that's awesome.
What's funny is a lot of times people don't really think like that. So like I have amortization schedule up. We were looking at a property the other day, and at 4%, a $234,000 house ends up costing you $402,000. So when he says, would you rather have the payment cheap, the reason why that's so important is you're not really buying a house for 234. What you're getting is you're getting a monthly payment every single month. And if you have a $1,100 monthly payment compared to a $1,600 monthly payment, because interest rates are up a couple percentage points, right? You're getting a better investment, even if you pay more for the property.
Right. Remember, 1% in interest rate equals about 10% in price. So if rates go up by 2%, the price has to come down by 20% to be about equal. It's approximate. Okay. I mean, do the math, but that's a rule of thumb.
Yeah. So, I mean, I can't talk, I'd be interested in your strategy right now. So Ryan and I and Caleb, what we're trying to do right now is we're trying to buy and hold on to a pretty substantial amount of real estate right now. And part of the rationale is even if a correction happens, our exit strategies 10 plus years, 15, 20 years from now, maybe even longer than that, because we're only in our 30s, it might be 30 plus years, to where we can lock in at these lower rates and just build a massive amount of wealth, and with inflation coming too, I'd rather pay that fixed monthly payment 5 years from now, 10 years from now with a dollar that's worth a lot less than what we're doing now. So we're using it as a hedge against inflation too. So, I mean, Jason, what are you saying? What are you preaching? What are you thinking?
Well, look, I can tell you, I have a couple different real estate businesses and a real estate software business as well. And everybody wants to just buy up as many assets as they can get because of all the reasons we've talked about already, but also they look at these hedge funds and these institutional buyers just buying up everything they can possibly get their hands on. And that is driving up prices, and that I think is going to continue. And that's actually good for mom and pop investors because those institutional investors are much better at raising their rents than mom and pop investors are. And just look at the way they handle their apartments that they've owned for decades. These are all like the same types of investors, right? And we're going to see. I mean, we've seen already very significant rent increases, but they're going to get a lot worse. And so the thing that has to give is the standard of living. That's what's going to decline for most people, and that's unfortunate. But get educated and get on the right side of it so that your personal standard of living doesn't decline, and hopefully it improves with some of the knowledge that we're sharing.
I think the people that keep the standard of living in their rentals high are going to be the ones that win as well. I mean, if you're able to bring really quality products.
Right. But regardless, it's going to get more expensive, that product, and it's going to get smaller, and it's going to not be in as good a neighborhood as it used to be. So if you talk to your tenant 5 years from now, for example, they might tell you a story, right, of how they used to live in a bigger, better house in a nicer school district. And now they live in a smaller, inferior house in not as good a school district because they can't keep pace because they don't own assets, and inflation hurts them. Inflation benefits people who have assets and have long-term fixed rate debt against those assets. And so there's a whole nother strategy I teach called inflation-induced debt destruction. And people can find out more at my website, on my podcast, on my YouTube channel, and learn more about that. But that's really the hidden wealth creator with real estate, with income property.
What was it called again?
It's a mouthful.
Debt reduction.
No, destruction. Inflation-induced debt destruction. Think of it as IIDD. Inflation-induced debt destruction. Yeah.
I'm going to look that up. For sure.
Jason, you just wanted to sound smart, didn't you? That's why you called it
that. It's well, what else am I going to call it? I can't think of another name. I mean,
Jason doesn't have to sound smart. He just opens his mouth, things come out, and I'm like, holy cow.
Hey, give me an easier name than that.
Yeah. Hey, I got one for you that I've been thinking about that Sure. I'd like your opinion on. So Zillow right now just exited as an iBuyer. So you have these hedge funds and institutional funds buying up a lot of properties. Is there a potential issue with supply and demand if the next Zillow or if a couple of these hedge funds just decide, hey, we're in sell mode now? Is that a potential risk for us?
Well, remember, Zillow was never a buy and hold buyer. They were always a flipper. And because their estimates don't work and they're misleading, okay, which I've been telling people for, ever since Zillow began years ago, they've now eaten their own poison, right? And so, they'll dump a little extra supply on the market, but it's meaningless. It's just not even gonna matter. It's not enough supply to matter in the overall scheme of things. And so, but the other iBuyers, they're also flippers. That's different from companies like American Homes for Rent and Invitation Homes and, BlackRock and, all these big companies that are buying homes for buy and hold. So that's a different type of thing. But yeah, certainly they could go into sell mode. Of course, but I don't see any reason why they would be anxious to sell these properties when they're a buy and hold investor, because they've got really cheap debt against them. Okay. And the rental market is just booming. I mean, prices keep going up and the properties are appreciating because they're printing all this fake money. So, what would cause them to want to sell? I don't see anything that would cause that. Now, granted, things could change. The world is dynamic, but for the foreseeable future, I can't see any reason why they would exit.
Yeah, I think there's a reason why Warren Buffett, I don't know how many years ago it was, but he said, hey,
yeah,
the best investment's single family residential right now. You just have to figure out how to manage it.
Yeah. You got to do a little work. I mean, look, but you got to do a little work with everything. Okay. There's no such thing as a passive investment. That whole phrase is a lie. Okay. I know a lot of people throw it around, but if you put your money in stocks, you better be paying attention. Okay, you're going to lose money if you just think you can hand your money over to someone else or to the market, and that is not going to be pleasant. So you got to pay attention to everything. Everything involves work and attention.
Yeah, and there's things that are definitely more active or passive, but it's not 100% passive, right?
Real estate on that spectrum is pretty good. Income property is. Yeah.
Absolutely.
Well, we're right at about time. If you could give yourself any piece of advice for the next 5 years or to anyone else, what would you say is the number one piece of advice you give people?
Buy good quality income properties, finance them with 30-year fixed rate debt at negative interest rates, and then refuse to pay the debt yourself. Tell the tenant to pay it for you, and tell the tenant to give you about $200 extra every month on each house. We call that positive cash flow. And then tell the government you're providing housing, so you should get huge tax breaks. That's my advice. And that's what income property does. I call that the ultimate investing equation. It's a phenomenal deal. Really, nothing else has that characteristic that income property does. It's a very special asset class.
I love that. Thank you so much, Jim. We're right on the right pace, and we spend a lot of property.
All right, guys. Well, happy investing to everyone. And again, get on my mailing list. We'll get you the white paper so you get a lot more detail on this and other things. And I've got the podcast and YouTube channel as a great resource. My main podcast is called The Creating Wealth Show.
All right. Right on, guys. Well, that's Jason. Thank you so much for being on. Check him out on the Creating Wealth podcast. Thanks, guys. All right. That's a wrap, guys. Jim here signing off. Additional resources, check out doorstodeals.com/071. If you're getting value out of this podcast, throw some love, leave us a review on your podcast player of choice. Then finally, for you agents out there, I know only 10% of you are actually actively own investment properties or doing an investing deal. We need to change that. Wealth and financial freedom comes through real estate ownership, and we're here to help you out on that. We're here to help you do more deals and help your clients out at a much higher level. So open up a conversation with us on how we can help you do that. So go out, live your purpose, and above all else, go after your dreams. Till next time. Thanks for tuning into this show. For more episodes and resources that will unlock doors to deals, check out our website, doorstodeals.com.